Guess who's
And
back again.
I was like, how am I spending a tenner every time I go in it? And I was just like, no, fuck it, I'm going to stop doing that shit.
I think, we got to keep talking about it, because the only way it's going to succeed is by education and by people buying into the new Bitcoin standard.
There's three tricks to what they do to basically make inflation look lower or be presented as lower than what it actually is.
They actually cut off people's bank accounts during COVID.
They're almost deliberately creating a market where it's going to become impossible for the average person to be able to afford a home.
The Freddo inflation thing is how we monitor the Freddo inflation. She was like, wait, hang on a second. I was like, basically, everyone in the UK uses a little chocolate bar as a gauge of inflation.
Roundup sound, ooh, yeah. Real estate deals. We lay them down, let's get those deals. Deals, 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 making money, baby.
Welcome back, anyone watching. We are episode 10. Today is another sort of ad-lib session. In the last podcast, we had Ronan on in filling for D, and D is back for this one.
Guess who's back again.
Fucking hell. And we're here.
Good
so
job you're married. I think
Good job,
we've
Ryan.
heard every other female person in the UK.
Mate, my what do they call it? My Riz is up there, you know. I walk past women and they just want to speak to me. But I'm like, let them take it, you know.
I've seen it happen.
Sure they do, D.
But we're going to ad-lib some of this episode. We do have two topics to hit and two questions to hit. And to be fair, they'll probably drag us out to the end anyway. But in this one, guys, let's just play it out and ask more questions if we want to ask each other more questiones. But we'll start with the topic. So we're going to hit Bank of England base rates quickly because they've just decided to hold them. And we're going to look at Berkley Homes and what they're planning to do now as well. And then go on to two questions. So let's start with the fun shit. Here we are. Oh, wait. Let's start with Berkley Homes. We won't start with Berkley because that's a bit more interesting. Let's start with a quick one. Bank of England, on the 20th of June, have decided the Bank of England is going to hold interest rates at 5.25%. And just a bit of commentary. So as we've been reporting, the decision was a close run thing, and the bank has opened the door to cutting interest rates in August. That would be the first drop in borrowing costs for more than 4 years. And there's just a little graph on the inflation and interest rates correlation from Jan 22 to Jan 24. So it looks like, but they've made it look like interest rates going up has helped the situation, but also CPI is a bag of manipulated goods, and that's the thing that we always need to remember, that if when a product gets too volatile, they tend to drop it out of the CPI index, which means because it's too volatile. But the whole point of measuring inflation is that you want to see the volatility in prices. So maybe there's some deeper economic reason that we're not fully versed in and aware of, which we're not appreciating. But if that is the case, then it is their job to educate us on that and make it more clear. But from what I've seen, it just seems like a manipulated basket of goods for political prowess. But interest rates certainly have tamed inflation. We've seen inflation come down, but as it would, because it just basically gradually erodes the economy. But that is it for the
Right,
interest rates.
Just on inflation there. The CPI, so they took out coffee beans last time I heard, and the thing I read about it, the reason the answer they give to take something out like coffee beans, which is, I don't know, gone doubled in price, is because they become too expensive. So then the consumers stop buying them. So they try and keep an average based on what people buy, which is just insanity, really. You know, you track the same things all the time and not take things in, add things out just to try and make the numbers look better.
Well, so some people in England
just get away with it in blind daylight.
So some people in England have stopped drinking coffee.
Well, no, the coffee beans have gone too high, so now they're too expensive. So the average consumer doesn't buy them. So then they take them out and replace them with other products that can be affordable. And that's how they they claim it. So that's what they try and do. But it's just
what happens is people start buying cheaper coffee, don't they? Like I don't go to Starbucks really anymore, or Costa or anything. I'll take a flask with me, Like, just because I've started spending 10 quid every time I went into a fucking coffee shop. And I was like, how am I spending a tenner every time I go in here? And I was just like, no, fuck it. I'm going to stop doing that shit. I'm going to just have coffee at home and I'll make a flask and go on the road with the flask. And I don't need to. I could just put it on the business card and not have an issue with these £10 here and there. But I hated the idea that I was spending 10 quid on a fucking cup of coffee.
I bought a McDonald's 2 days ago. I haven't had McDonald's in 6 months or 9 months or even a year, maybe. I don't know, but I was so hungry. It's like 3 o'clock. I thought I've got to get some breakfast. So I pulled into a McDonald's and got it. It was like 11 quid for like literally a milkshake, a quarter pound of a cheese and some chips. I was like, well, this used to be like 4 quid, 5 quid. I just can't believe how much everything's gone up.
So there's 3 tricks. Well, there's more, but I put it in the chat. I'm not sure if did I say about it last time? If not, I'll just quickly say it now. There's 3 tricks to what they do to basically make inflation look lower or be presented as lower than what it actually is. And those tricks are substitution, geometric weighting, and hedonic adjustments. And very quickly, what that means for substitution, I'll just read something from ChatGPT, what this is. This method assumes that when the price of goods rises significantly, consumers will substitute it with a cheaper alternative. So what they probably did there, Stuart, is the same thing there. It's like coffee beans have gone too high, so we'll substitute that for something else and put it into that pool of consumer things for the new index. This inflation measurement adjusts accordingly, potentially underestimating how much real-world prices are impacting, which is definitely true. The other one, which is geometric weighting, this technique assigns lower weights in the inflation basket to goods that are rising in price faster. By doing so, it dampens the visible impact of price increases in rapidly inflating areas. So that is also, so if it's rising too fast, they'll reduce the weight of that in that pool. So therefore, which is just, and then the other one, hedonic adjustments, which this refers to adjusting the prices in the inflation measurement for changes in the quality of goods. Like, i.e., you all remember the chocolate bars are getting smaller, but the price is either staying the same or going up. That is a hedonic adjustment, but it's not reflected, so to speak, in the inflation basket. So it's not the quality of goods is changing, but it's not being reflected. So yeah, that's
so it is a manipulated, an artificially manipulated.
It is manipulated. Yeah, definitely. So congratulations to miraculously getting down to 2% inflation at election time.
Speaking of those topics, and there's a classic English, I suppose, product that we all relate to. I was explaining to my wife, who's American, what the Freddo inflation thing is, how we monitor the Freddo inflation. She was like, wait, hang on a second. I was like, basically, everyone in the UK uses a little chocolate bar as a gauge of inflation. And it's just whether it's lower class, middle class, upper class, we all use the same metric. And she was like, right.
What is the price of a Freddo bar? It used to be 10p, right? Is it like 25
or 5p? 5p.
Yeah,
when I was a kid, it was 5p. Little purple 5p on it. And it was like, oh, Mom, can I get a Freddo? It's like, all right, just chuck it in. Chuck in a little Freddo. Like, it was a Freddo. And now you buy them online, they're a quid. They're a quid online.
5x in your life.
Yeah.
I don't know why I haven't seen more kids called Freddo, to be honest with you. Thought there would be a surge in the name.
It's funny that everyone uses that little chocolate bar. But anyway, Bank of England, they've decided to hold rates at 5.25%. If you actually read into the articles as well, I was looking at it live when someone dropped it in the group chat, and the commentary seemed to be that of the 9 committee members, there now seems to be more of a unanimous agreement that they are going to start cutting rates. And I think we all knew this was coming anyway towards the back end of summer. I don't think anyone was optimistic they were going to drop them now because of the election being around the corner, too much uncertainty. So I actually think it was a wise decision not to drop them, just to not pull the markets left, right and centre if they then have to jack them back up again. Depends who gets in, depends what tax measures and policy measures they bring in. So it's always crystal ball gazing, but I'm pretty sure we're going to see at least a couple point drops over the next 3 to 4 months. That should be what happens. That's what the market seems to be baking in. So hopefully our borrowing costs as developers get cheaper. And again, anyone out there who is a property developer, this is the stuff you want to keep an eye on, because it is the price of money, and whatever job you do, you're going to need money for it. So how much is your money going to cost? Well, you should keep an eye on this stuff because it's going to help you making educated decisions. But that's it for the Bank of England.
Just out of interest, and touching on borrowing costs for developers, a lot of people that I speak to that might even be in like a professional practice or in the stock markets or whatever it may be, say to me, has the change in interest rates really impacted your development company as a borrower, as like a developer borrowing money? But for the last 5 years, I actually don't really care so much what the cost of the money is, because if my finance costs are, for example, 8 to 10% of my costs, and they've gone up about 1% or 2 for development funding, it doesn't really swing the whole project that much.
No,
Where it
it's
actually
massive,
impacts
though.
is,
It's massive because we've got the obviously cost of materials, the cost of
That's the-
labour, and the cost of money, which means people aren't buying as quick as you'd
yeah,
want
so
people to sell
sure. So
stock.
the market isn't moving as quickly at the
But
tail end.
that's all part of the whole big picture.
Yeah, gotcha.
Cost of money is
Gotcha.
the cost of money is
But
throughout people who are selling stuff, and that they've
I
got to live
think
their lives. So
I think
go on.
Jack's referring to the exit being more
correct. Yeah.
impacted than the actual
Yeah,
build part.
the market at the exit, and actually, I was watching. I saw a reel from the ground up page when I was talking a few weeks ago about the like market sentiment being quite positive, and I was like, we've got a lot of stock for sale, and I'm not seeing it. That has actually changed in the last few weeks. Pretty much everything that we had for sale in 4 different locations is all under offer now, and
Is
in
it?
legals.
Oh, well done.
So I
Congratulations.
have
Nice, mate.
seen, and it was weird. It almost came in all on one day. Like
Oh,
back
nice.
in the last week.
What a good day that is, eh?
Maybe they saw the
Yeah.
pod,
Yeah,
mate. You never
yeah,
know.
maybe. Maybe the
But
general
I had
public
a
are watching the
Well, that
pod and
shows
thought,
you it's
I'll buy a
sentiment.
house off him.
yeah. I had a notification, not notification. I had an email come through from Lloyd's because we're doing a refinance with them, and they've got it at the moment as August 24. There's a 53% chance it will stay, but a 43% chance it'll drop to 5%. By November 24, there's a 32% chance it'll be 4.75, but a 40% chance it'll be at 5%. So let's see.
Yeah, it looks like it's one, doesn't it? I think it's gonna be one this year.
Somewhat.
I hoped it was 2, but
We'll
bollocks.
see. We'll see. But anyway, boring shit, really. But definitely, if you're out there and you're into developments, just start getting a habit of keeping an eye on this stuff. Don't buy into it too much because there's a lot of political aura around this stuff, especially when we're about to head into an election. So, but that's it. Now we're going to head on to Berkley. So, Berkley Group are a huge development company. They're a PLC in the UK, and they are establishing their own build-to-rent platform. Now, we spoke about this in the pod before, where Lloyd's and other major banks, as well as huge PLC property, they're almost like they're basically property funds, but they are developers going into the build-to-rent space. And we could start getting conspiratorial about the World Economic Forum sentiment on "you will own nothing and be happy." But here's an asset class that we all consider, our buildings, our houses, our homes, and we see a huge institutional push towards a rented sector rather than as much of a buying sector. But there's a myriad of things we could dive into, but let's just look at Berkley Group initially. So Berkley Group is establishing its own build-to-rent platform, adapting a strategic approach to maximizing returns from long-term regeneration sites. Recognizing the severe shortage of high-quality rental accommodation, Berkley Group announced today in its results for the year to 30th of April a natural extension of its strategy that will see the company establish its own build-to-rent platform. The new platform will be developed over the next 10 years. It will see the delivery of around 4,000 new build-to-rent homes across the company's 17 nature-rich, well-connected and low-carbon brownfield urban regeneration developments. There's a bit of a mouthful for you.
Yeah, say that
And
again,
then,
Ryan.
yeah, I'll come back to it, mate. We'll go over it again. Berkeley's position has always been that if it cannot deploy capital to deliver appropriate risk-adjusted returns, it will return surplus capital to shareholders. With the creation of the new build-to-rent platform, the surplus capital that the company indicated in December would be available to make additional returns from 2027 should no new investment opportunities arise, will now be allocated to the development of the rental portfolio. There's a bit loose there, really. Should no new investment opportunities arise? I'm not sure, what is their measure on that, or can they just basically if they want to do something, they'll just do it, and they'll mask it with, there wasn't any investment options here for us to build and flip another 1,000 houses, so we're going to go keep these ones. But I don't know what their duty is to their shareholders. I've never read one of their annual reports or anything. But Berkley sees this new platform an attractive opportunity to accelerate the delivery of its existing assets by building a best-in-class London and Southeast focused build-to-rent residential portfolio and platform. It will enable them to maximize value on their brownfield regeneration sites from this growing market segment to the benefit of both society and shareholders. Now, I don't know what you guys think on that, but I haven't heard great stuff about Berkeley's quality of buildings. So the best in class for a rental portfolio, maybe they'll do more on their spec or more on their build quality because they're retaining the assets that compared to flipping them. But I'll throw it to the floor.
They're pretty good.
Oh,
Yeah,
yeah,
the market
go on,
perception is that
educate me.
Berkeley. Well, sorry, you two probably know more than me. You're local to them, but from my point of view, from Wales, and obviously my experience in the industry, Berkeley public perception I know is also known to be, a relatively high-end developer, a high-quality developer, and there's hardly any really reports that they're contrary to that. What do you, Stuart and Jack, think?
Yeah, no, I've been around a few of their new build sites, and they're one of the top, in my opinion, in the country. I think the quality is fantastic. I'll compare our quality to them and try and smash them out the park when we can. But it's just going back to their shareholder bit. Just as a business, their whole model is to obviously generate cash flows for their shareholders. And what they're doing is they're saying that we don't really want to take new stock on, or if things aren't moving. So rather than sell your shares or buy out of our company, we'll make our share payout lower, keep the profits inside the company, and do the build to rent, which is a great model, and what Jack and I obviously are doing a lot of, and yourself, Rye. I mean, it's a great business move for them, but if their shareholders don't like it, then their shares could tank, which could be a good time to buy some shares of the Berkley Group. But it's just going the way the European model works, because it's becoming so expensive. This trend, I don't think, is going to stop. But it gives. Just looked here, just put in biggest rented sector in the world. You've got Switzerland takes the top spot, 61% of the country rent, and Germany 54%, and in Denmark 47%. I think London's like the 5th most expensive city in the world to rent.
In terms of the UK, we've still very much got that like the public, the marketing, even in the manifestos, is all about home ownership and improving home ownership, and the rent. Even though we know that rental is a huge part of, and it is growing. Just the perception still and the messaging coming down from manifestos is still very much encouraging about home ownership. Whereas I do believe that rental in the future will be, it's obviously going to get bigger and bigger and bigger. But just very quickly touching on the Berkley point, one thing just to note, obviously with Berkley is, these are huge companies. They've got their land holdings are absolutely massive. They've got over 65,000 plots in their land bank, basically, which is mega. And they in terms of build years, that's like 10 years build rate for them, or around about there. So, and they're a cash cow. Obviously, we're making money, and paying back shareholders helps them keep their share price also at a good level, because there's less shares in circulation because they're buying them back effectively. So their share price stays or grows because of that, and it becomes more of a valuable company. But I think, as Stuart said, in a market where it's hard to kind of sell tremendous amount of units, if you've got 63,000 in your bank and you want to build 4, 5, 6,000 a year, your sales market can be difficult. It's up and down, isn't it? But they've got enough cash reserves and liquidity to basically hold with debt some of these stock items and then package up as a portfolio. But they're targeting a 15% return on their equity. I think it was the public
for this model. For this model,
15% return on
model.
No, 15% return on equity is the metric for the build to rent aspect. That's what they've publicized.
Yeah, so just from like my lens, so we're actually really close to a lot of the Berkley Group stuff. They are, when you say, have they got a good view on their stock or not? I think they're the best of a bad bunch, in my opinion. I think any national home builder is certainly commented on their quality. Berkley Group is like sitting at around the 5th or 6th largest developer in the UK, behind Barratt, Taylor Wimpey, Persimmons, Bellway, Vistry Group. And if you name all of those names, none of them have got a good rap for their quality. So they are, in my opinion, better off a good good batch. I have a bit of a inside scoop on it because Ben obviously worked for the Berkley Group for a few years as their technical manager on the Riverlight scheme, which was 970 flats, a billion into the billions in gross development value in terms of scheme. And they are a very hyper focused, high quality, high paced, really good quality people around business. And that's fed from the Tony Pidgley days of leading from the top and working his way down. Even to the day he died, he was still in the office every day, looking at project cash flows, managing the teams, helping teams out. A super admirable guy. But to come onto this model, I'm not sure how it will actually work, because understanding a little bit of the inside scoop, Ben was actually could tell that they were just on really high margin deals. Most of their developments and most of their land comes from joint ventures from National Rail, Thames Water, and joint ventures with big landowners. And their profit on GDV and profit on cost is absolutely phenomenally insane. They target about 30 to 40% return on GDV after all costs. They're building out super efficiently. They go up and down the supply chain so that when they get to site, they're having as many bites of the cherry from materials, labour, all the way through to the actual product itself. But where I can't really see this working, so I agree with Dorian. I think there's many reasons that a company like a national home builder would do this. It's whether they're worried about sales rates, so they're building more stock than the market will buy. They're struggling to find new land, which Dorian's confirmed isn't necessarily true. They've got a good land bank that they can build out. They want to go in a new direction, so someone's taken it over and is just got out of bed and just likes build to rent, and is trying to then position that onto the business. Or they're just super cash strong, so they kind of got more money than they need to do their day to day, so they're throwing it into a different sector. And I think that I'd agree with Dorian, it's probably the latter. But if they're getting 40-ish% return on GDV, I would assume their IRR or their return on cash in their development company is way in excess of 15%. Probably high 20s, maybe even 30% return on cash. And also, if you are getting a premium in the market for your stock, it's not going to be the best stock to rent out. Your yield on that value isn't going to be the best. So I kind of feel like this would be better suited for a Barratt or a Taylor Wimpey, because their lower value stock would rent better and be a higher return on their cash, because they're all about volume, where Berkley Group are actually quite nimble and high profit margins for a development company. So it's going to be interesting to see what they do. And it might just be the case that they've got so much cash, they want to diversify and do a build to rent. I actually really like holding and renting, because I say to Ben all the time, when we do a HMO, we do the work once and then it's generating cash flow forever. When we do a development, you're only as good as your last deal. You've got to find it again, you've got to fund it again, you've got to take the risk again, you've got to deliver it again, you've got to sell it again, and then guess what? You've got to move on to the next one and make sure that you've got the next one. So I rate the business model.
And to grow, you've got to take bigger developments on where you can compound the HMO model.
Yeah, so I rate the model. I don't know if it quite suits their business. I think their business is better just to stick to the stuff they're doing. They're, in my opinion, if I were to be a national home builder one day, they would be the person that I would be trying to follow and copy their model. All of the, Barratt, Taylor Wimpey, Bellway, I don't rate. I just think they're a massive corporate, whereas I feel that the Berkley Group is kind of a very well-run SME company that has exploded, and they've built that off the back of hard work, good quality, and being creative.
But back to my point, where I was going with the Switzerland thing and the Germany, it's such a growing trend, the build to rent or the rental model, where people have the flexibility and the freedom to move around. They might be looking at this going, look, let's look 15, 20 years out. We're going to get left behind if we're going down a market where everyone wants to buy and the trend of people wanting to rent is different. I think it's the way it's going. I think they're copying the SW Homes model and just wanting to build to rent. Been watching us online and gone, you know what? This guy knows what he's on about. Let's just follow him. Let's follow his movement.
Here's some
Bitcoin.
here's some figures just off the back of what Jack said, because all of this is interesting. Uh, but Berkeley Group's like operating profit margin is out of that bunch that you've said there, Jack. They're the most profitable, basically, uh, and their operating margin is 27.8%, which is huge in the development world, and they're consistently known for being very high profit. But because their land bank is so big, and I don't know whether they own a vast majority of it, or how it all works, but apparently through Yahoo Finance, their return on equity for their development business has been around 18%. So it's not a tremendous drop to 15% for their return on equity target for their what's it called, rental model.
Build to
But
rent,
the
yeah.
other thing for the build to rent, the rental model is as Stuart said, is the future opportunity. The one big thing that they potentially, I don't know, I haven't seen the figures, but if their return on equity is based off their rental yield alone, and they've probably seen and witnessed the capital appreciation over the past 15 years in the southeast where they operate, and if they held on to a lot, a good portion of that stock, it's potentially going to be worth significant more in 10 to 15 years from now. But also, if they do build a portfolio of 4,000 homes, which they're aiming to do, it's the portfolio potential resale of a high quality investment at like a compressed yield to a PRS fund or something in the future in the time. And also, it's just, as we've said, it can help with continuity build, and potentially diversification. Or, as you've all said, somebody new's come to the business and said, "This is what we're doing now because I like it."
Dorian, just to touch on that, Rocky, as some people like to call it, or return on capital. That's not always painting the correct picture in a development company that's funding future sites. So in a growing trajectory, your return on cash can be 18% in a crystallized year, but if you're buying 20% more value in sight, you're not seeing that as a tail. There's a delayed tail in a development company. So, for example, if you looked at a company accounts of a growing development company, you're technically not ever going to see the clear profits from the sites that you're reinvesting into those future sites. So your growth hinders your return on cash, and they are still growing. They're looking at their revenue from 2022 to 2023, they've increased in size, in revenue size, by about 6-7%. So if they stopped growing, that return on cash, once you got through what would call the growth inertia period, it would probably be a bit higher than 18%. But I mean, like you say, 18% to 15 isn't huge, especially when, like I said, you don't have to keep on doing the work over and over again. From the way I work, I'd much rather get 15% of my money, do the work once and sit back, than do it over and over again and take all of that risk and time and team and headache for just 18. But that's not, the discrepancy is probably marginally higher from a return on cash because they've probably reinvested that into the future.
There's probably 100% definitely something like that in it too, and I fully appreciate that. I still think though that like they built the business model off a trading business model, which is obviously what I'm also trying to do as well. And it'd be interesting, which we will never know the answer because obviously the founders passed, but if what the founders' thoughts would have been in terms of today's world, to start the model again, would he have focused on build to rent first, or would he have focused on development trading first? That was, we'll never know the answer.
Do you think it's? I personally don't think it's individuals making intuitive decisions based on what they want or the company direction or anything like that. I think all of this whole build to rent push from institutional capital, which there's a big difference because we could talk about the difference of institutions and PLCs taking on a large portion of our housing stock compared to a diversified pool of SMEs. But I think it's more of an economic response to poor fiscal policy from our central banks, that because they've created a market from deficit spending, from unhealthy economics driven by the public sector, which can't afford itself, and They don't really have much choice here, but for asset values to rise. And then you think of planning and the bureaucracy and the way of delivering housing. They're almost deliberately creating a market where it's going to become impossible for the average person to be able to afford a home. And these big players at the top of these PLCs, that these are savvy people, the savviest of the savviest. I mean, I consider all of us quite savvy, and we can see what's going on. Imagine what their data analysts have access to, and what kind of models they're forecasting 5-10 years down the road. And they're going, yeah, I mean, your average Joe's, look, we have to afford a home, so the only option will be to rent. And that's the European model, and I think it's a disgrace to our country. Like we built this country's great because people own stuff, and we all have a decision, and we love SME. We're not Europe. We advocate business. We don't raise huge corporation taxes. We want diversified free markets, especially in one of the biggest markets in any country, because property is just a huge business. It's in the trillions all the time. And we're seeing these huge institutional players come in and go, yeah, build to rent is where we've got to go. And I just think SME are going to get drowned out of that conversation.
Well,
we're just going to get drowned out of it.
They are, but that's where our skill set of being absolute bulldogs and underdogs and Rottweilers come into play. I can see you in 20 years from now, Ryan, with a cap all the time saying, "Make UK great again. Make UK great again."
That's just because I'll be bald, mate. So I need to hide my fucking receding hairline. But I do think there's a problem with this forecast of big institutional money and big PLCs going towards, and banks as well, thinking owning the stock is better than churning the stock with SMEs who can dictate the path forward. Like it's great to have 20 apartments here, 18 apartments there, 50 apartments there, done by individuals under their own proprietorship to creating a product unique to them and their family or their business partners, compared to these PLCs swathing up land mass and just building a building and then controlling rental values. I just think we head towards a stagnated future in the housing market that is much like the European model. I don't know what you think about that, but I don't want to see big banks owning large portions of the build to rent space. Like, I think it would be boring. I think everything will look the same.
So what should SMEs do then? What's the advice, guys, for listeners of the latest information we've talked about?
I mean, interesting to put some stats to it. In 2020, 10% of the new homes in the UK were built by SME developers. In 1988, so what's the spread of that? 32 years. It was 39% of the UK housing stock was built by SMEs. So obviously the trajectory was back in the day, 40% of, and what you've got to remember is, because national home builders build at mass, that's a shitload of SMEs building loads of little pockets on brownfield in settlement developments like us. But that's a huge decline in 30 years. We've almost gone down to a quarter. And do you know what? When we were at UK Reef, there was a private developer there that's been, and I'll state this really carefully because Dorian picked me up on this. They've been developing for 85 years, but the lady that was there is not the one that set up the business. She was part of the firm. And she was saying that every year that they're in business, because their gap is getting, so cost of finance is going up, cost of building going up, cost of labour is going up, cost of land's going up, they're actually building less than they were 50 years ago, which is crazy, given all the technology and all the tools that we have in our arsenal to grow our business, rely less on people, be more efficient. If you look at Amazon, I could get something delivered to my door later today, having ordered it from my phone here and now, but we're building less houses than we were 40 years ago. It doesn't fucking make sense.
Bureaucracy. That's what's done it.
Planning.
It's like, planning.
I blame planning.
Planning and regulation, though. Like, regulation is like an ever creeping disease in any sector. Like, because planning is clearly an issue. The whole thing just needs to be completely revamped. Whereas
I do agree with some of the regulation, though. I mean,
exactly. That's the problem with it.
Building more energy efficiently, building more fire safely, building better sound quality, but all of that stuff I do.
But that's the problem, though. But that's the problem, that regulations and laws, you can always find a reason to go, but it's safer. But it protects our children. But it protects it. What about in this scenario where this happens?
Yeah, but some of these things are actually safer.
They are, but we existed for thousands of years.
Some of these old houses, even they were building, is not the like. The problem is, right, if you build, Well, that's a more of a longer investment as well. If you build energy efficient houses, that do help reduce bills, but also make the house more more efficient and safer to kind of be in. Then that is an investment for future generations as well, because hopefully more disposable income to be from doing everything else. But just let it being sick less, blah blah blah, less drain on it. So and obviously it's better for carbon as well. There is always a limit. I agree with you, Ryan. I definitely agree with you. But I think as society, we should always be thinking how can we be doing things better and make the product better for the end user,
But it should be a free
whilst
market
not
deciding it.
putting in barriers to, like Wales, for example. The way Wales like to deal with new regulation for housing is by dropping a bombshell in with hardly any information, making it legal with immediate effect, and then letting between the developers and the authorities thrash out all the details in a very, very long-winded and laborious and costly way, rather than actually just bringing in a regulation, very detailed, very easy to follow, and slowly build on it. That with is no, it's not ripping the system apart. If that makes sense. They don't like to do that here. They just like when surface water, urban drainage scheme systems had to come in. I understand why it has to come in, and I agree with it. But they just dropped it in and said, right, basically can't discharge anymore into the foul, so combined. So deal with it. And then you're just like, and we're still dealing with it now, 5 years later.
I've got a bit of a question, yeah. Like, this is what I genuinely believe, unless one of you can convince me otherwise. Why should an energy rating be a mandatory thing in the building code? Why can that not be a choice of the developer? If I want to build a home that's not thermally efficient, that's poor energy quality, I should accept that the free market will respond and reprice my product, because they're going, well, if I'm going to buy that, mate, it's going to cost me more in energy bills.
Not when there's a shortage of of options. They won't.
What do you mean?
Yeah, I disagree with that.
But but there's a shortage of options because of the regulatory barriers. As in, it's an all-in-one thing, isn't it? Like, if we keep allowing regulations to creep up and creep up and creep up, eventually it becomes impossible to do anything. Like the same thing with laws, isn't it? That the more we allow new laws for these edge cases, the more eventually everything will trend to being illegal. And that's what ossifies a society. And that's exactly what happens to the Romans. It's what happened to societies of the past. They regulate too high. They make it impossible to move and stagnate a free market. And the second we stagnate a free market, we die. We can't improve because everything becomes illegal. Everything has a stop guard. And we're seeing that, I think, in the development sector. And it goes hand like glove and fist with planning. You've got planning on one side, you're getting permission for the thing. Then when you've got to build it, there's so much to dance around that for an SME like developer, imagine starting out to navigate this landscape over here now becomes so difficult compared to what it was when the Victorians were building. And arguably these Victorian homes are of much better quality than the ones we have now that are getting built en masse, although they don't have the
Bring
thermal
back the open
efficiency.
fires.
Yeah.
Bring back the no cavity walls and open fires.
Isn't it? If I want to die from an open fire and I want to have CO2 poisoning or carbon poisoning from the open fire through my house rather than underfloor heating, I should have that choice.
I'll tell you what, you should use a bit of asbestos as well. That's pretty good kit. I mean, obviously, so like I think what Stuart and Dorian are seeing through that to some degree, it's just to some degree, I think there's a bit of a protection of the consumer. Unfortunately, the public aren't that smart, and you would get idiots buying them and not realizing that it's going to cost them $5,000 a month to keep the house warm through the winter, and then they end up fucking going bankrupt and going to the FCA or whoever they want to complain to. So unfortunately, I think that it's building the classic phrase that everyone always uses in this capacity is try play a football match without a referee, and you will have referees that are good, that let the game flow for the viewers, but maybe is a little bit less likely to pull up cards, and you may get referees that stop every second because they've read the rule book and they're pretty antsy about certain particular types. And I feel at the moment the referee is of the nature it's very pernickety, and it needs reviewing and adjusting, and it needs to be a freer flowing game. But they need to be there. They have a purpose, and they do need to be there.
That's actually a really good analogy for what's happening, because equally in football, in the referee scenario, we always need a referee. Granted, we have to have guardrails. I completely agree. But remember, for thousands of years, we built shit better and quicker than we do now. Granted, there was the slave trade as well, and that allowed for an abundance of labor, which was abused. And we have to kind of take things into proportion, in proportion. But with the football scenario, you do need a referee. But what happens is the referee ends up convincing the consumer, because of that consumer risk, which is always touted as the reason for more regulation and laws. But because of that, they then create a secondary regulatory body, and they call it VAR. And then they go, do you know what? This referee stuff that's worked for 100 odd years, I think we should add another layer of referee and pause the game and stagnate the game. And that's what
So
happens.
do you know where I feel that it is lacking? If you're using the same analogy, if you're a football player and you play football and you love football and you've enjoyed playing football and you've played football all your life and you've had good refs, bad refs, medium refs, you've had good games, bad games, whatever it may be, and then you become a referee, understanding it from the player's perspective, it makes much more use for the whole game itself. What we're seeing is the councils don't understand what it's like for us, and they are going, right, we need to do this, we need to do that, we need to do this, but they're not listening to the players. They're not reviewing the game from other perspectives, and they're going, we need to do this, this, this. Oh shit, let's put another fee in there, like section 106. That's brilliant for us. Let's do this, this. So it's not understanding it from the full 360 model, and there's not enough enterprising thought process going into it. But I believe there should be, standards put in place, and people should be abiding by those standards. But I don't think that the people making the decisions on those standards are best informed, are the smartest. And if you got dropped into HMRC for a few months, you'd be like, fucking hell, this operation is slick. They know what they're doing. They're a great. I believe the HMRC are probably one of the better publicly run,
the most
forms of the
incentivized.
entity. Exactly. And that's because there's money involved, and they're sharp cookies. But then if you look at the council, it's a bit of a shambles. So it can be done right, but I just don't feel that they're looking at the full 360 and putting the right thought process and the right people in there making the right decisions. And that fundamentally lies down to government and pushing from the top.
Yeah, right on your point. I think that if you didn't have those regulations, developer greed would kick in. Everyone would be building cheaper shit, which long term would have a huge impact. And yet, trying to educate the public on what is a good property. I think the EPC thing is good, and obviously everything we do is trying to be EPC create the highest EPC possible. So I do think there's regulation, but like Jack said, having everything added on this curve that we've now gone through, it can't go on forever. The regulations can't get higher and higher. I think we're hitting that plateau. Now it's a case of taking everything we know and redesigning the whole process. And I think privatising the council system and the full regulation, like Jack said, as a full 360, build the playbook and then issue that to SME developers, everyone who wants to build their own properties. And we'll have a much slicker process. But it just takes someone. I think they're going to do it in the government. It's going to have to be privatised to make that happen.
I think the problem is that the regulations will plateau and stop, because you now only have a few big players that dictate the market. They've achieved what they set out to do. There was 40% SME developers. Now there's 10, and soon there'll be 5. Then there'll be 2% of us, and then it's just a round table game with the big companies, because they've ossified the market by raising the regulatory barriers so high that it's impossible for anyone to participate. That's the problem. And I agree. Obviously, we need regulation, we need standards, but the free market did it way better than we did. The free market is much better at regulating than any centrally planned regulation ever will be, because if you respond to good, healthy incentives that the market determines, you're always going to build a better product than if someone tells
was there ever
you
a free
see this
market?
in social.
Whether you're in
More
Darlington
so,
or London, the
but more
Victorian
than what we
house
have
was a
now.
Victorian house. So I mean, even the regulations back in the late 1800s, there was always the playbook. It's like, you can go and build this, and you can build it in these areas, and that's why the same Victorian property is the same all over the country. But if you create a playbook that's standard for everyone, actually SME builders will increase, because everyone will know the game they're playing. So it's like having one fixed referee. No, I know, but it's because the regs are changing all the time to disincentivize people to get into this game. Where if you made one playbook that you could teach at college, or people could create education platforms to go, these are the rules. Because the scary thing about development is you get into it, and then they, like Dorian said, they just put a new regulation in and boom, deal with it. And that's where the big risks are. which put a lot of SME builders off.
To flip it on its head, regulation and barrier for entry is difficult and makes our life more difficult, but it also deters competition, new competition, people coming into the industry and doing what we're doing. So there is a takeaway here for, I think a lot of our listeners are entrepreneurs and business owners, that sometimes you can embrace this barrier for entry and work it in your favor. Get good at what you're doing, get the right people around you, get the right process in, play the system, and operate in a market that's more difficult to access because of its barrier for entry. And I see that in the HMO space. The more regulations coming in, the more difficult it is for people to get their head around it and skill up on it and make the mistakes that we once made and grew with it. In the development space, for sure. Like, even using my father for an example, he can't be bothered with planning anymore. Full stop. He'll just be like, "Oh, fucking A, I'm not doing that. You got to give me, this is a fucking waste of time." And he's always looking to cut the quickest corner to get whatever he needs to get to and then walk away from it and hands it over to other people. So I do think the old school will be weaned out because, this is what we're used to. This is the new norm. And I do think that it makes it easier to be, fewer players in this space, because it is such a, if you were setting up a development company now, it's so much more difficult than it was when we set up. And I think it's more difficult than 10 years ago, and they'll think it's more difficult than 10 years before then. So it's the way the world's going, but you can try and play the system a little bit and use that to your favor.
Do you think it's one of the hardest industries to start a business? So not to start a development site, but to start a development type of business?
I always say a development company is like no other company that you'll ever set up, because you're technically, when you set up a development company, you're setting up multiple little businesses that only run for 2 to 3 years. So every development site you do is almost like setting up a new business, new strategy, new idea, new risks, new team, new product, whatever it may be. And you've got to think of the whole spectrum: sales, marketing, operations, finance, and the team that are going to deliver that. And you then build up several other businesses around that, and then you have one holdco that's got to then manage all of those other businesses. So there isn't really any other business like, there's some examples like solar farms. I would argue that's still sort of construction / real estate, where businesses build up solar farms and they set up SPVs, and it's exactly the same structure. But it's not, if you go, I've got an idea, I want to go and create this product, whether it's an app or it's an actual product, and then you go through rounds of funding for R&D, then you pre-launch it, then you do sort of a beta phase and you test the market, and then you grow a team around that, and it's a startup business. That's a very, very different business model. Do I think it's the hardest? No, probably not. I think there's harder businesses out there to run. There's businesses out there, for an example, that you might be in research and development for 50 years before you even go to market. I would say that's a really, really difficult space to be in, because it's a very when you look at the life duration of a human, and then you look at the launch duration of those products, it's super difficult for one passionate person to get that out, get it translated, get it launched. So I think there's harder businesses out there for sure.
No, I think I'm not saying that there's, because obviously advanced manufacturing, robotics, that they're all those industries and those kind of companies are obviously like much harder. Typically, they're started by huge war chests anyway. They're not really SMEs starting. I should reframe the question really. If you're starting out and you've got aspirations to start, say, from square one to build a business, there's only really a certain pool of, obviously anything's possible, but really for most people, that you can only start in certain industries at a certain level, and development is a low barrier to entry to some extent, because if you only need money, or need to know someone with money, and be able to leverage things to be able to get started. But I do think that being a developer, compared to building a tech business, anything in SaaS or tech, there's quick ways to address the market, quick ways to do this and that. But the capital risks you take on in development, on top of the underlying business and the operations, are so big that the failure rate's obviously so high, and then they're so dependable on the market and market conditions and political sway and councils and red tape, that there's just a lot in the way of delivering a product or service.
I wouldn't say it's the most technically challenging, but I think one of the riskiest. And I think most people want to run so fast, so quick. Once they understand level 1, they're like, oh, great, I can get straight to level 10. But you've really got to take your time with the size of developments and learn all the lessons around them sort of products and those sort of sites. And then as you grow, you just need to go slow. I think as soon as people that we all know that have grown so quick, so fast and just lost everything. So I think it's definitely one of the riskiest business plays to do.
Yeah.
But technically challenging. It's just you need to take the time to learn all these rules and regulations as you take each step on the journey.
Where our product, if you actually boil it down, our product is housing, and the biggest expense that anyone forks out in their life is housing. It's the most expensive thing that they trade on. So if you boil it down and really, really simplify it, we're slow, massively large transactions and big decisions for people. Even if it's renting, it's still the biggest expense for a person. And using one of James Sinclair's terms, he's more of what I would call like a product, smaller product-based business owner. And he always says he loves businesses with lots of people, little amounts, and often. There's like 3 rules. We're not lots of people. We're one person is per product. We're large amounts, not little amounts, and we're not that often. Where the average person moves house every 14 years. So the assumption of when they actually transact, if they move house 5 times in their life, we're part of that 5th transaction, for an example, in someone's life. So we're not often, we're not lots of people, and we're not a little amount. So we're in a space where, unless you're in the rented sector, which kindly actually links into the Berkley group, they're actually moving into lots of people often, and not so large amount, but it is still the largest expense for a human. So it's a big decision for them to make. So as a product, we're reliant on 3 years worth of hard work, graft and team costs for one transaction, which then sort of relieves it all and pushes stress. And the market is a huge player in that. As Dorian says, in a rising market, being a developer is probably one of the most profitable types of businesses. But in a falling market, the tide goes out and you haven't got any speedos on. Super difficult space. There's a lot of exposure, I would say. A lot of people, and I actually, talking about barrier for entry earlier, I find that property attracts. We were actually talking about how much of Alan Sugar's wealth was in real estate. A lot of business owners go into real estate as an asset class to put their capital, and property does attract a lot of accidental landlords or unprofessional landlords, unprofessional developers, because it is considered as a commodity and asset class like gold or crypto or their business in their reinvestment. And equally, that can also be quite a difficult space for people that aren't used to it. Again, that sort of, it is a low barrier for entry of people wanting to get into it, but from a technical perspective might actually outweigh what they need to understand specifically for development, not necessarily landlord and ownership, which obviously the government and taxing try and get unprofessional landlords out of the market for that reason.
Well, what do you think? I'll start with D on this one. Another little question, because something Stuart said about fast scaling developers going bust. So D, what do you think are the core reasons for why, if you want to grow quickly in development compared to other industries, although cash flow always being one of the reasons why it fails, what's the more underlying technical reasons, and judgments that are poorly made that make for a fast growing development business to go bust?
Well, nobody, in my opinion, ever sets out to go bust. Nobody ever sets a business and thinks, "No, I'm going to scale this and just explode." So the biggest problem straight off the bat there is they don't know what they don't know, and you won't know what you don't know until you've actually gone through a round or two, or a couple of fights, etc. And that's where that growing too fast. There's nothing wrong with growing fast or growing quickly once you know and actually have that information that I've done a few of these deals. I know this market. I know what my costs are. I know what my sale price are. I know what the demand is. I know where my funding line's coming from. I know all of my metrics, and I know what the track, which is if it flashes orange or red, I know I can tone it down, type of thing. With all respect, the biggest problem is people don't know that, so they'll scale. And we are definitely had that experience as well. We set the social house building company up and scaled rapidly, but we set it up at the time where effectively it was a new product to what I was used to building, and we set it at the time just before the high cost inflation. But because we didn't have enough data, we only realised the cost inflation was really hurting us too late. If that makes sense, we signed too many contracts up. If in hindsight, there would have been probably about 4 or 5 developments I just would not have signed a contract for, and I would just waited. Basically, the best decision I could have made in hindsight was just waiting, just literally that, i.e., not growing, slowing down, stopping, and just
What's the
waiting.
technical part there? What's the so you'll
Well,
wait,
there's
but
nothing.
what are you waiting for?
No, they didn't know. They didn't know. They just didn't have. You need to have data. Basically, it comes back to the lean startup, right? Is the MVP with development? You can't really do an MVP because everything you do is material. But you can do a project, and you can get as much data as possible, and not necessarily rush it. And this is if you stand up and you don't have much behind you. On the flip side, which we've talked about, there are equally some startup companies that grow extremely fast, and they don't necessarily worry too much about losing money in the first couple of years, because for them, they know that it's expected because of this exploratory stage and data gathering and refining and tweaking the model. That's okay if you've got the funding to do so or the capital partners to do so, and it's more about a macro opportunity that, this sector is rising at like 20% compounded annual growth rate. We need to jump in and capitalize on that. So you would jump into that sector and you would expect to lose money for a couple of years whilst you figure out, but the fundamentals there and it will work sooner or later. Whereas if you're like an SME, small business, and you're going to go and work with an investor who's going to like lend you their pension, blah, 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 you can't afford to do that. Your deal has to work, and you have to de-risk it by actually doing a deal in the area you want to do, to get data, to understand what your build costs are, understand what the market depth was. Because when we all start out, these Excel spreadsheets tell us that, yes, we're going to do a development for 10 or 15, and it's going to make 25%. But the problem is, if it takes, after you finish the development, if it takes a year to sell those 10 to 15, because that's the market depth of that area, your profit it's going to 100% be significantly lower than you expected. And then going forward, your sales rate, because you may have nailed your build cost, you may have nailed everything else, but if you've got your sales rate wrong because of the area you're in and the price you're selling for, etc., then your model needs to be. If you didn't have that data and you were on 5 or 6 sites at once without completing that cycle, and all of them worked off the original assumption of that sales rate being, I'll sell 10 in 3 months, but really it takes 15 months to sell 10. I'm just hypothetically, your model's flawed. So it'll always change, but there's nothing technical about it other than just not having enough data to make decisions.
But you don't think there's a technical? Yeah, but you don't think there's a technical aspect where you're going the cost of capital and sales rates and things like that? There are things you can. Let's say it'd be useful if we had a case study, I suppose, of someone or something that's tried to scale really quick and gone bust. Because you'd think that because in a lot of industries, if you scale quick, depending on how you're funded, like how the consumer interacts with your business, but if you scale quick, generally you should be building up a war chest or building up a market opportunity to then be able to raise capital and scale further. Like if you are running a deficit,
only if the model works.
Yeah, only if but development models do work at scale, right? They do work at scale.
Well,
yeah,
we're all missing the fact, make it work.
We're all missing the fact that these big companies that scale fast have actually had 10 years of slow growth, which have been off the radar. Yeah. So they're not running a million miles an hour. They've spent a long time getting all the foundations right, getting all the systems lined up, learning all the things they need to learn, and then they'll execute, raise capital, and go for it. And that's when they come on our radar and we go, wow, they've come out of nowhere.
So what is it technically about that slower approach to then scale compared to those that want to start and steroid inject and go super quick? Like, what is it technically?
It's kind of like this. It's called the hockey stick effect. If you look at Gary Vaynerchuk's like success in life, if you look at another example is Shake Shack, to open their second branch took something like 8 years, but then in the following year they opened like 30 branches. Once you get to the trajectory where you're at, the bigger you become, you get exponential growth. So it becomes easier to get bigger when you're already bigger. from a business. I mean, talking back on like the reasons why development companies, I think fail is like Dorian quite rightly said. I think market and economics is one. So I think there's 4 reasons, and then I've got a what I would call a curveball or an anomaly for this. So the market and the economic situation. So if you're building out, like Dorian said, building out a load of stock and the market sort of tanks, the finance and the costs of not understanding that is point number 2. Regulation is point number 3. And I think in private SME development space, it's very unlikely that's going to really impact our product unless you're in service accommodation, HMOs, whatever it may be. I'm talking about private house sales. And then point 4 is the competition. But what that doesn't include is Roger Hamilton, billionaire, always says the biggest bottleneck in your business is always you. And when it comes to a development company, we've actually seen collectively quite a few talks from developers that have gone bust. And I actually believe most of them it's because of them being the bottleneck. And, Dorian and I talk about it all the time. We saw 2 speakers at an event, and both of those speakers that are developers have gone bust. They're paying themselves like 20 grand a month take home. And one of the reasons that their business has gone bust is because their house is, a £12,000 per month lease, lease rental property in like Wentworth estate. They're driving around in Lamborghinis, and they're not focusing on the core metrics in the business. And out of those 4 things that I mentioned, it's all about managing risk for us. Out of those 4, so we've got economics, finance, regulation, and competition. You can only control one of those, and that is your finances. And they're probably spending less time on managing risk than they should be. So I believe the biggest reason for a developer to go wrong is the people that are running it. Is actually the biggest reason, not actually all these factors that we keep out looking out of our window and going, what is it? What's the market doing? I think the biggest reason for businesses failing is the person operating it.
Yeah, no, fair. I'd say you probably hit the nail on the head there when you think about what correlates to any business failing, especially in developments, because you can take outsized risks in other industries, but your capex just may not be that high per transaction or per product or per growth rate. Whereas in development, you just need to make one bad decision at the point of transaction, and you could take on 2-3 million of debt and have no exit. And if you're bad at decision making, or you're not frugal and don't allow your business to have cash flow because you're fucking shedding it on a Lambo, then yeah, quite quickly you can miss an interest payment, and then the bank's coming for you, and you fucking can't make the next one, and then you foreclose.
But in that, and I agree with Jack. But also in those examples, though, when you listen to them talk, what the original idea when they set out and did deals, obviously what actually happened was completely different. I.e., the deal didn't work as expected, and I've already shared a statistic here that majority of development deals do not finish on time or on budget, and there's so many different fundamental reasons why a development business can fail. And yet, 100%, I agree with you. The individual, like the leader, the co-founders, the partners, they've got to be really invested in the business itself and learning and constantly looking at those metrics and understanding the business fundamentals. But they've got everyone listening to this, and us, 4 of us, have always got to be looking at our business fundamentals, our data, and understanding what's right and what looks abnormal. And is that set to continue, or what can I do about it, so to speak? Because it'll just run away with you. And then ultimately, the fundamental reason is everyone just runs out of cash sooner or later if those mistakes keep happening.
On a very micro level, just in the last few days, thinking about our 18 unit scheme, I'm making myself say this saying all the time: if it's not going to sustain or increase the rent, then we're not going to do it. Because I get so emotionally involved with our little sites, so we'll happily spend a little bit more money here, spend a bit more money here, but we've got to look at it from a commercial basis. We're doing a build to rent scheme. Is it going to increase the rents, or is it going to make it more attractive to pay the prices we want to make the scheme work, or not? And I think that's the same with every decision you make in business. If it's not going to help you on your trajectory of where you want to go, then don't waste your money. And the other thing you said about Lambos, is everyone else seeing? I'm getting so many more people on my Instagram feed and reels now who are just living this nouveau riche lifestyle where they just want to burn cash. I just don't understand it. They're almost incentivized to go pop just blow up and then disappear. And
Well,
I
are
just think
they
it's fucking
selling
mental.
a course in the description?
They're selling everything, whether it's the digital creators that are just living this lifestyle where they just think money's an abundance that's going to forever come in.
I mean,
It just makes you feel
we're
sick.
in to sort of touch on that. We're in a really unhealthy space where money and spending money on silly things actually spirals for better viewership online and supports their habits. Whereas, before, back in the day, if someone had, bad habits of spending, they'd end up going broke and be, depressed because they haven't got any money. Now, the social medias of this world actually supports that. And buying a car and driving it around and crashing into trees for a day actually gets viewership, and it's completely like the most random, like unethical and unrealistic and unsustainable business model, but it works. Like Mr. Beast, released a video of himself the other day, see how much money he could carry, and that is like literally dangling it in our faces that money is making this world go round. And it's a new normal, which I'm not used to. I mean, I'd rather.
Yeah, but what effect is that having on young people and people thinking it's okay to do this sort of stuff and just think that it's okay to burn money, because that actually increases our debt society, puts more pressure on the country, and it actually makes things 100 times worse. So where is this thing going to end? I just think
that's where I don't agree with Mr. Beast morally. I like that the guy's clearly impressive, but I just think he's just exploited attention by doing outlandish, ridiculous stuff. And then, of course, young people are going to like watching that shit. I don't think there's anything genius behind it. I do think his resilience is very impressive, and that is ultimately why he's won. But he definitely set a tone amongst young people, which is a big problem because those young people end up running the world one day, and we don't want young people to be desensitized to the value of money and the value of frugality. Like, frugality never gets spoken about now. Like, it's not something that young people have any aspirations for, to want to live your 20s nice and frugal, work hard, build up a war chest, and do what your parents usually don't do, where they'll take a long time. In their 60s, they might be able to retire and have this chilled out life if they're lucky. Whereas you can do it early. You can completely reverse engineer it if you give up your early life first, almost like, those are the hardest years you work.
Make sacrifices. Yeah, make sacrifices.
Yeah, and make the sacrifices, because then you can live in abundance in your 30s or in your 40s and 50s and forevermore. But it stems from frugality, because if you can't start by keeping your personal expenditure down, you can never get into a point where you can grow a business. I don't think you unless you borrow loads of money.
What I've so I used to be super frugal. Always had to earn my own money, and that's how we were brought up. So I did, funding myself through, teen years and university, and naturally was super, judging what I was bringing in against what I was spending, and kept a really close handle on that. But what I've really struggled with lately is doing that, because I've sort of become immune to costs, because we're spending thousands day in, day out in the business and doing this payment here and doing that payment there. I've almost got that like confrontation therapy, where because you're spending money day to day in the business, I become less frugal in my personal life, because and when I say less frugal, I'm still probably considered super frugal. We're not the developers that go out and spend 20 grand a month on our personal expenditure. In actual fact, myself is the lowest paid person in our whole company group. And I think that's the same for Dorian and probably you two as well.
Yeah.
But I find that immunity is weird, that I don't look at, I'll go and spend, 100 quid on dinner, and it just doesn't feel like a lot of money, because I've already spent 6 grand that day paying for a survey
or an XP survey.
Hey.
You are right. There's a joke that in this type of business, every problem that comes up, or the invoices are always in the thousands and tens of thousands all the time now. They never. I was actually sat in a meeting. I said, why can't we just have £100 problem anymore? Why can't someone just come in and be like, oh, we missed this invoice, it needs paying, and all right, how much is it? £120. Right, okay, we're gonna sort. No, now it's well, we've missed this invoice. It's not on the system. It needs paying yesterday, because it should have been paid 3 weeks ago. I was like, how much is it? 35 grand. I'm thinking, what? How the hell can that? These are just.
I think it's
figures.
It's a prioritization of problems, isn't it, as you naturally grow. And I know we know this anyway, but obviously, we actually the other day needed a hard drive. If we didn't get the hard drive, we couldn't have continued the lads would have struggled with editing. So, and that was £100 problem. That was just £100 problem, but it did stop the train there. Like, we needed this £100 thing solved. But if I just proportionally go and look at the same conversations I was having that day in the construction business, I'm going, well, there's a 30 grand problem as well. So it's just a prioritization, isn't it? You don't care about the 100 quid anymore. You're like, just fucking pay the 100 quid. I've got to find 30 grand. Like, you just start to think on different levels, which just pull back to Jack's point. It can desensitize you to your own personal payments. I'd say running a personal cash book is the best way to be able to keep control of that, because you can see over a month how much you're spending on sundry items, and you go, fucking hell, I spent 150 quid on coffee. Like Starbucks.
We do that every
my problem with problem with that, right, is that same as Jack and you guys. I'm frugal. I just naturally I don't even try to be. It's just I only draw from my revenue streams and businesses and portfolio, etc. I think we live off less than, what is it, £3,500 a month, like kind of all in. And that's it. That's like as a combined household as well. And that in today's world, that's not a lot of money really, if you consider two people. So because of that, I don't.
Four people,
yeah, and
Dorian.
kids. Four people, sorry, but because of that, I expect that to go, so to speak, and I don't really budget that for the pound to pound, because I know that in realistic terms, I could effectively double that if I want, but I don't want to. I'm keeping everything in the business because the business really does need capital to be reinvested in them because of all the opportunities. So, and because of all the efforts based on business forecasting, and I know you sort that problem out and then we'll sort this one out, so to speak, which I'm obviously choosing for that to happen. I don't spend time for budgeting or forecasting personal, kind of like what you said there, Jack. So yeah, I similar boat, I think.
And just for anyone listening out there wondering, why do you not fucking pay yourselves enough? And I do think that to really be a successful business owner, at some point you should be paying yourself nicely, or at least have built something that is paying yourself nicely like that. So we want to get to those points, but the reason you pay yourself not much initially, if you start any business, and you should be the last on the pecking order for getting paid well for a long time, because you're actually getting paid inadvertently, or you should be, in appreciating equity value. So you're actually getting, your wealth is building. That should be the idea, which is the reason why we'll all take the last penny, right? Fundamentally, it's because we own the business, we have the equity, and all these people that work for the business are contributing towards building that net equity for us, as long as we're doing it properly. So there is a
Ben and I always joke that when we send our assets and liabilities over, it looks good on paper, but it doesn't feel like you're that wealthy.
Yeah.
I think to close up on the pound thing is, to be a successful business person, you have to understand the value of a pound, and I think you have to understand that in your own life, and you have to put yourself last. Yeah, in like Rye said, because you have to reinvest everything into creating a secondary source of income, or whether it's from flipping properties or building them and holding them long term. Live on the secondary income that's created, but don't spend the principal. You always reinvest that in the business, whether it's in new people, new systems. But you have to understand the value of a pound.
Value of a pound, baby. All right, should we get on to the two questions? We've got the last half hour here. So we have two questions. This one first from Shadley Jacobs. Thank you for your question. He put, great episode, gents. I'm new to the UK, so don't know many people. Welcome to the UK. So I enjoy listening to you guys. Anyway, seeing that you guys discussed some politics, so how about some positive in a sea full of negativity happening in the world? El Salvador, the Bitcoin guys should know. Yes. El Salvador, as the Bitcoin guys should know, as their official currency is Bitcoin. They have completely eradicated crime. They are now officially the safest country in the world. They've arrested and jailed over 70,000 criminals. Their president says he seeks God's wisdom in decision making. I know this isn't property related at all, but the good in the world always gets silenced by the bad and evil. And I thought this was just a bit of a curveball question, because I don't think we're going to get many questions that are kind of like this. So to try and deduce this into like a question that we can all sort of respond to, how can we relate it to the UK and property? Well, El Salvador, I don't know if you guys have seen it, but it's well worth watching. The El Salvador president, can't remember his name, did an interview with Tucker Carlson and spoke about what's happening in the West and how we are ossifying as a society because of higher level politics and bureaucracy filtering down. And it's what we've spoken about in this podcast today. We see it in regulation, we see it in the planning sector. And Argentina is doing some interesting things at the moment where they are going gun-ho at the establishment to try and get rid of these layers of bureaucracy that are there, that are ossifying everything. But El Salvador did a massive turnaround in their crime rate. They went from one of the most dangerous places in the world to one of the safest places in the world almost overnight. There was also at the same time an open border policy in the US where a lot of criminals fled to get free entry to the United States. So I don't think there's a direct comparison there that's sort of fair to say, but they certainly, through government intervention, through trying to stimulate a free market to some extent, managed to turn a society around completely overnight. It's a fascinating podcast that was done between Tucker Carlson and the El Salvadorian president, well worth listening to, and it highlights what's going wrong in our country and what's going wrong in other countries. That the more regulation we bring in, and the more open border fucking policy we have, the more our crime rates are going up. Like, how do we solve it? And we've got this election coming up, and then there's no one really talking about. I mean, they are talking about how to fix the open border issue in the UK, because we might as well have an open border at this rate. We've got a big advertisement policy that says, come here and we'll look after you. So obviously they're going to try and come over in droves. But yeah, just flipping the conversation a little bit. What do we think about how what they've done in El Salvador, and how can we in the UK help to bring crime rates down? Like what is it that's going wrong? What can Labour do? We're going into an election now. Labour's looking very likely to win. What are the steps forwards for us to, or in our opinion, what are the steps forwards for us to make sure we have a safe country, even though we've got hundreds of thousands of migrants coming in every year who don't necessarily buy into our culture and our way of life? What do you guys think? What do you guys think of that as a topic?
Wow, well, I'm so glad that this podcast is bringing in people who sort of understand a bit about Bitcoin, and it's exposing people who aren't necessarily adapt to what Bitcoin is. I really wanted to get into this podcast anyway, just to try and help myself try and explain Bitcoin better. I think I've done a poor job to date so far. President Berkley's done a great job. I think, we got to keep talking about it, because the only way it's going to succeed is by education and by people buying into the new Bitcoin standard. He's done a great job by seeing the light. Bitcoin is effectively God's money. It's untouchable from other people, other countries or governments. And what it's done is it's created a bit of a call-in for people who have got obviously a lot of Bitcoin that have moved to El Salvador. And if you change the money, you change the world. And I think that by having something that with El Salvador, it's very difficult to know how many people are using it at the moment, because their cash is obviously being depleted, and the money they're extracting, they've created basically a treasury where they can start trading within their country tax-free, which has given them the freedom. Obviously, the IMF really wanted them to stay against the dollar, which is having a huge impact on their lives. And I think that as Bitcoin is increasing in value, they're living in a Bitcoin standard, so their currency and things are effectively becoming cheaper. Because if you look at Turkey and you look at the BRICS system, which we need to do a whole thing on BRICS really, and what's happening there, where you've got the other side of the planet, you've got Russia, China, Brazil, all of them are pegging away from the dollar, which is going to have a huge impact on our global currency. And all it's going to take is, and you've also got Saudi Arabia, who've come out of their 50-year commitment with the US, basically saying that we'll protect you as a country with guns and ammunition and war if you peg all your oil to dollar. That's coming off now. They've come out of their 50-year agreement, and that's going to be an interesting point, and could be a tipping point of which, if they start pegging stuff to Bitcoin or the BRICS system, then other countries are going to fall like a stack of cards, and everyone will move away from the dollar, which has a huge impact. So yeah, we're going to go through a very volatile period, and I think El Salvador has become a bit of a safe call-in, because they've made it tax-free and you can trade it as effectively their currency. That other countries are watching. And I know Bukele's having meetings with lots of different smaller countries around the world. They're going there, seeing the ecosystem, seeing how he's created safety. And the money system is the most important thing of any country. And if other smaller countries, it's people furthest away from the power, which is the US and the dollar. And then you obviously got the yen, the euro, and everything else. It's all these smaller currencies that are really failing or just going off the top of a cliff in terms of debasement against the dollar. That as soon as they start doing the same as what El Salvador has done, then Yeah,
Death by a
it will
thousand
happen.
cuts,
It'll
isn't it?
happen so quickly. Death by a thousand cuts. It'll happen so fast that you need to have a 1% exposure to Bitcoin. Just learn about it, because you can't afford not to. When this thing fails, it's going to fail fast. And everyone I meet now, I'm trying to get them to at least learn about it and go away and watch. There's so much on YouTube now. You need to go and learn about it.
And
It
what about
seems to be. I've just googled the percentage of coverage in El Salvador. It's about 30%. And actually, the other underlying percentages of people just not actually really understanding it, which is what I think the talk about barrier for entries is. I think the barrier for I had Bitcoins. I just found it so complex and complicated. Maybe because of the securities and remembering where you got this, that, and the other. But there is quite a bit of friction there for someone that just likes an easy life. And you can imagine for people that don't even have phones or have ever used technology. I'm guessing El Salvador's not a first world country. That's a huge part of the population. We're using quite an advanced thing in a very unadvanced country.
Well, but Kelly's gone straight in at sort of year 5. So for 5-6-year-olds, they're learning about the Bitcoin infrastructure. So he's actually being one of the first movers to try and teach everyone about this system, so they don't have that problem. And actually, more people are unbanked in the world than have got mobile phones. I think like 88% of the human race have got a mobile phone, but only like 40% of the globe have got bank accounts. So it's actually easier to get to people. But we need someone like Apple to come along and go, right, you can have a wallet on your phone. Here's your seed phrase, and you can tap and spend money like you would do normally and have as less friction as possible. But there's going to be resistance. But now you've got like Trump, man. He's like, Bitcoin, we're going to create it. We're going to mine it in the US. We're not going to give it away to global. So this whole presidential election there's 50 million Bitcoin users or Bitcoin understanders, which is what, out of 360 million. That's quite a good percentage share of voters.
I think it's 100. I think it's 100 million in the US.
In America, I thought it was like 300 million. No, I don't
No.
know.
Sorry, I think it's 100 million Bitcoin holders in America.
Oh yeah, I mean there might be 100 million Bitcoin wallets that are located in the US, but I think they reckon there's like some people own as much as 20 wallets, so it's very difficult to know exactly how many people own Bitcoin. But he's got his own NFT. I mean, there's so much in the crypto world. We have to really break crypto and Bitcoin. Bitcoin is there's only one Bitcoin. There'll only ever be one Bitcoin, and there's a load of great ideas in cryptocurrencies. 99% of them are fail. I think there's like 20 odd million now. So Bitcoin is completely separate to crypto, and understanding what the Bitcoin network is and the Bitcoin current or Bitcoin store of wealth, it really is economic energy. It's undilutable, which is so different to what we're used to in their own local currencies, where they can just debase it. And we are literally up against trying to work harder and be debased. And I know I keep banging on about it, but really, I'd love to put some links up here and just say, watch these 2-hour videos, watch these 1-hour videos, and just try and understand the value of what money is, because you've got.
So, just a question for you two, for a layman like me, what one I get the deflationary and changing of the value of the market. I get that, like it's decentralized, no one can control it. Different countries can't control it, different to others, and blah blah blah. And one of the reasons that people love Bitcoin is it's untouchable or controllable. So I think it was in Canada. They actually cut off people's bank accounts during COVID, and that's actually one reason that a lot of people are moving into the space, that they can't be cut off by government control. But looking at the El Salvador take on this, it's a new application called Chivo or Chivo, CHIVO, which someone's got control of. So if they're all adopting and going on this app to control and use and spend it's called the Chivo wallet, which is obviously controlling the payments. There's someone there that's got the control to go, nap, we're going to pause that. And,
it's actually open source. So these DAO systems or decentralized effectively wallets is this open code, a bit like Bitcoin, is that no one can control the protocol that creates the amount of Bitcoin on the network, which is effectively a big spreadsheet. In my world, it's just 21 million lines. You can own 100 million for one line, or you can own a whole line, and that can be transvalued. It can be sent around the world.
So is Chivo
I'm just looking at it now.
Source?
I'm sure it will be. I've never heard of it. There's hundreds of these things, but ultimately, you've got crypto exchange wallets which are owned by nobody. They've been created by developers. They've been put out there.
But this specific example of El Salvador.
So Chivo. So Chivo says this. The Chiva wallet is owned and operated by the Salvadorian government.
There you
The
go.
administration led by the president. Given the wallet is state-run, the government has the authority to manage and regulate its functions, including starting or stopping payments.
Yeah. Okay.
So I mean,
you don't have
I mean,
to. You don't have to have that
yeah.
wallet. You can have your own cold wallet. You can still use Bitcoin, but if he's trying to make it, what he's trying to do is obviously he's holding the purse strings, if you like, of the Bitcoin that El Salvador own. But you in that country where Bitcoin is free to trade, you've got people there who will then understand it will probably pull their Bitcoin off of that wallet and into a decentralized wallet that they can then use and transact in that country without any rights. He's probably done that for security of his people more than having control.
It says that in El Salvador you can use other wallets, but so if the Bitcoin law does not restrict them. But El Salvador they bought $100 million worth of Bitcoin, which they run in their own wallet, which is currently up to about 150 million, I think, at the moment. So they're doing well on their investment.
Well, they're buying one Bitcoin a day, I think, is what they're doing, which is a drop in the ocean compared to some of these institutes that are now buying in.
Buying thousands.
Michael Saylor bought another 27,000 yesterday, I think, as it's hopefully break out and go to different levels. But, there's a saying that says, everyone pays the price of Bitcoin of what they deserve, the price they deserve. And, there is only one way it's going. And it's unbreakable now. It's unstoppable, in my opinion. And the quicker you learn about it, the more you're about to buy. I think they reckon there's only going to be about 300,000 people around the world who will actually own one Bitcoin. If just by owning a part of a Bitcoin, I think it's 0.1 of a Bitcoin now, you'll be considered super wealthy in the future when everything's pegged to the value of what Bitcoin is, because everyone will lose faith very quickly in other currencies when they fail. And and I just can't see any other light now. Once you understand it and you've been it's called orange pilled, when you you just see the light and go, shit, how have I been so brainwashed?
That's the main thing. And I think, Jack, in answer to your question, like to help the layman man with Bitcoin, the understanding Bitcoin is basically a journey on understanding what money actually is, like what money really is. And to do that, you have to understand the protocol of Bitcoin, because it's the protocol of Bitcoin is describing what money should be. But we have these other forms of money that we've called money, but they're not really money. Like the pound and the dollar isn't actually money. Like if we really went into what is money, the pound and the dollar is nothing. All it is, it's a promissory note that's no longer even promissory because they can't fucking afford to pay it back. So they just keep printing more of it and devaluing it. So the journey to learning Bitcoin, learning and understanding the underlying technology, the protocol, teaches you, oh, that is what money is. And then fucking everything switches. It's like a paradigm shift in your head, and you go, fucking hell, the establishment is, you can't, the establishment's there to fuck us all over. Like the central banks, the government, they work in collusion to fuck us. And we know this because our parents, like I'm sure all of our dads maybe at some point went, the middle class pay for fucking everything. And that's what that means. Like the middle class do pay for everything because the system's designed to extract from the middle class. We don't have a money system. We have an extortion system. And learning Bitcoin teaches you, actually, there's a much better way we could do this, but we'd have to give up quite a lot to get there. We wouldn't be able to have this abundance that we have by doing
like the CPI. I was going to say quickly, the CPI we're talking about at the start of the podcast. It's so blatantly obvious that they take things out and put things in. The money system and printing money is as blatantly obvious as well. It's absolute fraud in every degree, where anyone else would go to prison and spend the rest of their life in there. But the government seem to have this free power, which is run by money and people. And it's just so blatantly obvious that I just can't see why it hasn't gone faster than it has. But then if you look at the last 14 years of this product that someone's got to believe and trust in, now we've opened so many, there's so many floodgates have opened now with the ETFs. There's like 40 odd ETFs now around the world, and it's being suppressed by people who have got lots. But when they sell it, you never buy back as much as you've got. And there's a point where people always sell, which then will spread over more and more people over the next 10 years. But sorry, D.
The problem. No, I was just going to say the problem I got, like probably a lot of the SME or business or entrepreneurs listening here, is that if you've only got a limited amount of cash, that you can only either grow a business, which absorbs cash, most of them do, for a while. Like ours is still absorbing cash, so all cash is going into that business, and everyone we pay and everyone we operate, as I speak right now, all fiat currency. So the money, obviously, it all has to transact in fiat. So there's no cash to come out to put into a reserve, effectively, like Bitcoin. So what do people in that
That's
circumstance do, and
that's
also those aspiring entrepreneurs
that's
that need
yeah,
money?
that's where it's good to go listen to Michael Saylor, because he had the same problem and he
Mm.
treated it as a treasury asset. It's a company treasury is how you have to think of Bitcoin. So you have to tax yourself a certain amount, say 5% each month of whatever profits there are, rather than allocating everything to forward funding new sites. In your case, Dorian, or in our case, funding our own developments, we make sure we take a portion and put it into that Bitcoin, because we're building up a treasury asset on the balance sheet that long term is going to probably outperform all of our property gains. So just by allocating a
Yeah.
small amount here, we're strengthening not only the sovereignty of our business, but also the underlying capital appreciation in the business relative to the fiat standard, and diversifying into a new economic landscape that will emerge. So if you don't do it, then you're never going to get into that system. So to me, it's like if you run a business, you have to treat Bitcoin as a treasury asset on your balance sheet, and it's something that underpins your business in the long run. There's just a 5% allocation a month, or whatever it is you can afford. It's almost like you have to do it, because if you don't do it, the world's going to escape ahead of you, and then everyone's going to be playing this new Bitcoin game. And if you're stuck in the fiat game, it's going to be like climbing up a sand slope, because the fiat currency is going to hyperinflate. There is no other way out of it. It will hyperinflate. And when it hyperinflates, it's going to be like treading quicksand, and Bitcoin will stay as this strong asset, strong reserve, and businesses backed with a good portion of Bitcoin. The same way we all have property, like property will also stay good. So if you hold property on your balance sheet, I think you'll also be safe. But you should also hold Bitcoin, because it's disconnected from that fiat system that's going to go to shit. That's what I
Just
say about
on
it.
your point as well, Dorian, the book I mentioned on a previous podcast, Profit First, your business, we should be taking out profits that we're actually working for. I know we're trying to reinvest and grow the business, but we should be looking at month for month, even if it's £100 a month into for either your business account or your salary. I'm not suggesting to put 20, 30, 40 grand in. I'm suggesting put 50 quid a month in, £100 a month in, understand what it is, and just peg this little bit of money to drip into Bitcoin, into that network, because it will happen. It's almost inevitable. But yeah, you need to put profit.
Okay, so very quickly then, for those who are listening, if they say that 50, 100, 150, whatever pounds a month,
Yeah.
they start going. What's the wallet you would recommend, or trading platform you would
Coinbase.
recommend? And
I'd go listen to
yeah.
Brian. What I did when I was picking a wallet is I went and listened to the CEOs or the founders of the biggest exchanges, and listened to them on podcasts, and just tried to find who are the people that run it and make the decisions. Do I trust them? I heard the Z guy at Binance and just thought, I just got a bad stink about it. The FTX stuff just looked mental, and I didn't like the guy was just a weirdo. And then there was Brian Armstrong, and Brian Armstrong, legit entrepreneur, super switched on guy, completely against government regulation and capture, but is also for stimulating regulation to allow the free market to prosper in the new cryptocurrency landscape. But has openly said that if the government tried to crack down on Coinbase, he'll domicile somewhere else to make sure that he's not domiciled in an oppressive country. So Coinbase, I think, is the best. And then put it into your Coinbase hot wallet, and then start to understand how a cold wallet solution works, and then transfer it from your hot wallet to your cold wallet. And then once it's on the cold wallet, you're truly sovereign. No one can touch it. No government. No one can ever get it. You are completely safe and off the system. There is no safer asset class. It's in your head. Then is the information you then store in your brain is your wealth and your value.
I would use someone different. So I started with Coinbase because I didn't really know where to go. But the trouble is with Coinbase, Brian Armstrong's a great guy, and I totally believe in what he's trying to do for the planet. But their fees are quite high. So I wanted to find someone who was EU regulated. And I was recommended a firm called Swissborg. They're based, I think they're registered in Lithuania, but ultimately they're based in Switzerland. I've met the owners, Cyrus and Alex. Cyrus is the owner. I was lucky enough to be invited to France and Paris. I mean, they're a great company, got great morals, and their fees are a lot cheaper, but they only pre-select coins or cryptocurrencies that they truly believe in as well. And so it's a much smaller outfit, but to buy and exchange Bitcoin. So I buy it on Swissborg. It's called an on-ramp. So I'll put cash onto Swissborg. I'll then exchange it for Bitcoin, and then I'll transfer it from there. I normally keep sort of 10, 20 grand on there, but then I'll transfer my Bitcoin account onto a cold wallet, which is then stored offline, and it's called multi-sig. So it's basically broken up into small pieces. That password, I don't know the total code, but ultimately there's 12 words which you need to put in a certain order, and it takes the first 3 letters of each word, and that is your 86 letter alphanumeric password. So there's 2 parts of a Bitcoin. There's the Bitcoin wallet, which is almost like I imagine this see-through box in a safe where everyone can see everyone's wallets. You can see what's inside each of them, but it's in a Perspex lock box, and you need this 86 alphanumeric code, which is the key that opens that box. So you need 2 bits. I can transfer, it's push protocol, so I can push Dorian into his transparent box as much Bitcoin as I want. Once I've pressed send, it's gone. I can't recall it, but I can't open Dorian's box about his other 86 alphanumeric code. So that's how it works. It's just a complete, and it's infinite amount of wallet addresses you can have. Like there's more code options to have as many boxes as you want forever. And every Bitcoin can be broken down into 100 million parts called a Satoshi, named after the group or people. And I totally believe it was built in the UK. I was just looking at the emails and the white paper and the whole history of the cypherpunks and stuff. I think, is it GCQ? Is it the building that was built in the UK around 2008, 2009? That might have something to do with it, in my opinion. And obviously we are quite, what's the word? We're quite an inventive, UK is quite inventive for so many inventions in the past. Why was it not something that they could foresee failing in 08, 09? It's just so ironic. It happened around the same sort of time where the Great Reset happened. But yeah, the owner, or no one owns Bitcoin. So having that, I would use Swissborg. So I go back to the point because I can go off on a tangent for hours about it. Taking 1% of bits I learn and trying to piece this story together. But that's why, like, Michael Saylor is so good, because he's so, what's the word? He's just so.
He's astute.
Elegant.
He's a very astute man, and he knows what he's doing. It's worth, Dorian. You'd love listening to it, Michael Saylor.
Did you? I've just. I don't know if you probably already talked about this, but during the research, I found that the UK government seized 61,000 Bitcoin as part of a criminal operation, and they held the Bitcoin as part of the UK's holdings now. So the UK government now own it. Did you know that?
US.
I did the same. Yeah.
Did you?
Yeah, I love it.
So,
free fucking money. Last question then, guys,
so
and then we're probably going to get to the end. But I thought this was taking it back to relative business stuff. Although, I'm not going to disparage the point. Bitcoin is relevant to any business owner, to anyone out there. Definitely go and learn it, study it. But this is a bit more direct about CRMs. So L4D question. I have heard you guys talk about systems, and Stu in particular on a previous podcast mentioned his CRM of choice is Salesforce. I wanted to know if you guys can share a run through of your chosen CRM and systems you have in place to help run your businesses. Thanks. Love the content you guys are putting out. LD. Thank you for your comment. And anyone who has questions in the future, please drop them in the YouTube comments, and we will endeavor to answer them on future episodes. Everything's up for grabs. So if you want to ask any question, we will try and answer it. Jack, what would you say to this, mate?
Yeah, so we use predominantly HubSpot for a CRM. So that's lead generation all the way through to close lead, and then customer retention there on after. We can also do email marketing throughout the back of that, code it, manage it through the process. So predominantly we use HubSpot, similar to how Stuart uses Salesforce. In our development company, we actually just still use spreadsheets for people management. There's less clients that we have to manage. Obviously, if we're selling a load of stock, the estate agent might have their own CRM system, but managing investor lists and things like that, we just use Excel because I like formatting things and creating rules and using the sort of intelligence of an Excel spreadsheet. But yeah, and then we use a project management tool called Asana, but we're actually looking to integrate that over to Mondays.com for like management and task management. But yeah, they're the 3 we use. I'm sure one of us would be more than happy to take LD through it on a screen share if they want to group up with one of us, but that's what I use.
Yeah, nice. Dorian?
Yeah, so as Jack has touched on there, if I focus on the development company, because we don't have like a CRM, so to speak, that manages the whole business, because the development business it moves at a fairly slow pace, if so to speak. We have a big pipeline, but these transactions take so long that it's not like a fast-paced sales environment where you need or client leads, etc., that need like managing. But we also have HubSpot as well for kind of like the directory, so to speak, and our marketing team use that for what they do. But from a construction point of view, we have construction project management software that has the CRM in that for all the construction related supply chain. So we work on that, and that's called Procore. But other than that, the business is run through quite a structured system of meetings and reports. So there's, for us, what we've done is we've broken down the business of how obviously a development should happen from A to Z, and we have divisions, and each division has its own set of objectives and KPIs, and basically workflow, and that all gets connected up with the rest of the relevant team, and mainly myself, through a structured set of frequent, whether it's weekly, fortnightly, and monthly meetings, and also reports. And that's how everything gets kept track of, and that's how information flows. But we do have various softwares throughout, like the Land CRM effectively is on Landstack we're using at the moment. That's where a lot of like the letters and leads, etc., are stored. But then we also have Excel that sit alongside that. Construction, which is construction, commercial, and technical, has Procore, which has its CRM in that. And then all the project information within that. Marketing has HubSpot. But then ultimately the whole business gets connected together by that suite of connected meetings and reports. Does that make sense?
Yeah. No, nice. And Stu?
Well, yeah, we use Salesforce. I literally run everything from the first initial inquiry right the way through to the maintenance at the end, and who is the electrician, the plumber. We can keep everything, part P certificates, everything's on there for us to use. Ultimately, with we're just going through trying to build a new cash flow forecast, which we're trying to use Sheets because it just makes so much sense for everyone to have a live update of what's going on, and it's so great that you can interact anywhere you are on your phone or at any desk. Effectively, I can log on and make changes to our cash flow forecast, which we're trying to feed into the appraisal document. We're trying to feed into all of our live costs. So we're trying to make one document with 6 or 7 tabs, which I can then duplicate and use for the next one, and just put our lessons learned in, extra costs that have happened. We can just add new lines. So we're trying to gear it up where it's future proof, which we had a big meeting this week, actually, just trying to get everything we want on the appraisal document to be at the front end, which is good for the banks, for the MS, for the cash flow, and for the pricing. And then we can just sort of draw down off of everything we've put in cost wise. So projections versus actuals. And then any new items that we have added to our contingency, the document can just be amended or just be added to, which then creates our next document for the next site we do. So you never know what you don't know. So you have to build something that's robust enough to amend and edit on each project. So we know by the time we get to project 5, 6, 7, this document should be pretty much bulletproof and well tested. And then we'll take that document and then probably put that onto something a bit more secure, I would say, because obviously this document will be quite valuable once we've got all these lessons learned, and then we can put it into something like Salesforce and build then all the new processes around all the fields that we've now tried and tested over the next 5, 6 projects. So yeah, that we use that as a bit of a foundation, and then take all the fields and data that are actually important and then feed it into something like Salesforce. Otherwise, you do what we did with Skylofts, which was just trial and error 8, 9, 10 times, but adding too much data, taking data out, adding more, taking it out. And it's just a lot of energy. So just taking all the lessons from that. This is, I think, the best way to create the architectural piece, which is the whole sort of development project management bit.
Nice. Yeah, I mean, we do everything. We try to do everything through Monday.com. So we use that from the start, really. Started on files and native stuff to the laptop. And then the second we put Monday.com in, it was like a light bulb moment where suddenly we could see the business. And we were just like, fucking hell. And then ever since, just always tried to improve it. And Monday kind of gives you a blank canvas. And then you got all these different boards and workspaces and status columns and activities and things you can add in and create in your own way for whatever use case your business needs. So Monday.com is banging for what we need. I'd be interested to see Stuart using Monday.com for the same thing he's doing on Salesforce and see what's better. Salesforce is a great CRM though. So it might be better in terms of leads, and stuff like that, Salesforce may be better. But I think for project management and operations and workflow or systems, Monday.com is so good, so intuitive, and it's kind of infinite for what you can do with
Yeah,
it,
but
but in
that's
easy
the problem
UX.
the problem I see with Monday, which is great because it's so easy just to open a new page and open a new idea and open another page and open a new idea and open another page and have this different dashboard for this. The trouble is it's so open that you can almost have infinite amount of ideas and pages, where actually you want to strip it all back and have the fewest amount of pages
Yeah.
possible. And that's where I think you'll go into open new systems and then shutting down those pages, or we used to have a page for that. And that's what Salesforce does, is it keeps you really sharp on making sure you want one page, I want one screen with the amount of data for that person on that job role. And once they filled it and press save, you want it to automatically send out an instruction to someone on site to say, this is what we need you to do on this job. Or if there's an overriding change, you make the change, you press save, and you're not relying on sending that email to tell someone. And that you can build the whole map where the less systems and less processes you can create is the strongest business model. So it's difficult to know what that balance is. And I think Monday, if I was on Monday, I would have 40 odd pages doing 40 different things, where I could probably do it on 3 on Salesforce, because it focuses you on making sure you capture
That's
what you want.
actually why we stopped using Monday and Asana. I didn't say, but at the early stage of the company, we obviously tried Asana, Monday, Trello, etc. like that. But we just found a similar thing. It was too much, and ended up being lots of different tabs and lots of different ways, and a lot of information that would never really get looked at again. So with that, we went back down to just having, like I said, what each division needs to do and their own workflow, and then having that connected meeting structure really, and then using Procore, which effectively does what Salesforce does there, but is geared up for construction. So everything's run through that on when the site is live. And we put them on there for pre-live sites as well. But if anything happens on site, everyone gets notified because everyone's connected to the job. Like the job is in the middle and everything's connected around it. If there's an instruction, it comes through and it's got to be signed off automatically, has a workflow of what needs to happen, otherwise it won't be approved. Purchase orders are on there, links with the accounting system, photos are on there, daily diaries, the reporting to the document system. So yeah, it's and again, same as Jack, I'm very happily, if anyone's interested in construction, doing a demo on that.
I'll tell you what, why don't you do a
maybe
demo
we
on
should-
Procore? Because
maybe we
that's
should
one that
do
I'll be looking at.
Yeah, we should maybe do it
Yeah,
on a pod.
we could do it on a pod. We can do it, jump on it together. So
Yeah, it could be interesting for an episode. Jack, you want to switch to Monday? Well, I guess you've looked at all the options. What's your thought process there on switching to Monday and not do something else?
Yeah, so the reason that so Asana is basically an Excel spreadsheet but formatted, so it's like a user interface where you can drag boxes, allocate things, put a date on it, put a priority on it, but you can't actually calculate numbers off that. So I can put in, it's very qualitative, whereas I feel that Monday.com has got a better blend of quantitative and qualitative information. So that's why we're looking to move to Monday.com. I completely get what the guys are saying, and you sometimes build something so overwhelmingly, detailed that it actually does the day-to-day still get done if you need it to. We actually focus on, so what I actually find more important than what you're using is actually how it's used. So what we do I believe that a systems and a CRM or a project management tool is more important in a service-based businesses like Skylofts or XP Surveys, and probably less important in a development company, because there's just too much going on and you don't need to look at it every day to be like, oh yeah, we need to order the tiles. Oh yeah, we need to, or that is a micro process that which we've discussed.
Oh yeah, we're still waiting for planning to be determined. Oh yeah, we're still waiting for planning to be determined.
Planning pending.
So the way that we use it is actually how we forecast that in team meetings. So we have a weekly team meeting in XP Surveys. We run through all of the business requirements, all of the job requirements that we've got, jobs coming in, jobs that are being currently surveyed, jobs that are currently being outputted, current jobs that are due to go out. And it's super beneficial for that business. We don't actually need to have that many group meetings in XP Property. It's more acquisitions team meeting, it's more delivery team meeting, it's more finance meeting, and broken down into different segments. We do use it to throw information at the wall and make sure it's stored there and we know where it is. So I think when you're looking at these softwares, it's also really important to think about how your team actually integrate and communicate and use it as well. Because as you know, Stu said, you don't want to build a load of stuff that you don't actually end up using.
Yeah.
It's just because you've got infinite, you can let your brain go into an infinite amount of thoughts going, oh, that's really important. That's really important. But actually, is it to get you from A to B as quick as possible? But what Jack said about the development thing, rather than a service business, yes, it's important because you're reporting to a customer. To me, it's as important to report to the investors. And I think that by having a nice trail where there's so many things from third-party consultants through to updates with the engineers, updates with the demo team, right the way through to getting the planning and then actually getting everything in procurement. I'm just trying to do what a 30 grand or 60 grand a year job would do over software. And I think you could bridge between the office and the development teams on site so much more straightforward with digital plans, digital instructions, all the bathroom suites, the choice of tiles or tile panels, whatever we're using, can all be done digitally, which, I think Salesforce could easily do that. But that's why I'm quite keen to see what Procore does to bridge between the office and pre-construction and the delivery of the site. If we can nail that, then all we've got to do is go and find the right building and put the right building at the top of the process. And then boom, we'll be spitting out units with very little risk. I mean, you never get it nailed on developments, will you? Because there's always something new to learn or a new policy that's come out that fucking changes this, and you can keep adding to it. But I think the key part.
I'll give you that demo, Stuart. Yeah. I think it'll suit well, especially because you're quite systematic as well. So I'll show you.
Mate,
but apologies, guys. Yeah. I've got to go and do the school run.
Okay, mate.
Cool run, big man. Well, yeah, that does bring us nicely to the end. But yeah, thanks, big man D, coming back on the pod. And we're at the 10th episode now, guys. So we've got 2 more till we're at that sort of 12 target, which is our initial goal. And then we're going to basically review and just have a look and see what the engagement's like. And if you're out there and you want us to keep doing these pods, let us know in the comments. And if you want questions answered on the next pod, let us know in the comments. YouTube's probably the best place to do that, or is the best place to do that. We release these episodes every Thursday at 5:30 a.m. on Spotify and YouTube. You can see all of our social medias and bits and bobs in the description. Thank you for watching. Big love. Fuck the government. Big up Bitcoin. And
learn about Bitcoin.
Learn about
what
Bitcoin,
is money. Man. What is money? Put it into YouTube. Watch some videos.
Developments. Do some Bitcoin. But yeah. Anyway, Salmon guys, thank you for listening, and see you in the next one.
Roundup sound.